What's up, everybody? Good morning. Welcome aboard to Trading with Bubba. And of course, markets are a little bit mixed to lower this morning. Had Case-Shiller housing, which was a good number. Had consumer confidence, which exploded. And yet the markets can't really gain any traction here. It's really kind of slow. Big earnings week, starting with Google this afternoon. Again, it makes the markets a lot more challenging. I think that when we look at the picture, let's start with the futures on the short-term basis. Pretty choppy, kind of working their way lower. Not a lot of activity to trade. We traded live this morning. Had a couple of trades, worked out okay, but nothing great. And again, there's not really enough of overall action in the market here. And if we go, to the bigger, the longer time frames, and let's just go through our list like we usually do. Apple is now towards the bottom end, but really it went from overbought right and retraced right back to the mean. I would think somewhere around here, with earnings, again, you got to be very careful with earnings this week. You had earnings on Thursday here. So is it really something that you want to get involved in right now? And the answer is probably no. If you're trading the option world, you're going to be way overpaying for premium. So I think it's probably best to kind of observe unless you can find a position to put on. But basically, we are at the mean, and under normal circumstances, might be looking for a buy opportunity here. Amazon earnings this week as well, exploding back, still very overbought. Here's one that I might look at selling some call spreads into the earnings, assuming that they've already priced in a good earnings report. With the amount of layoffs from Amazon and other companies, the economy doesn't look very good, although they keep telling us how good it is. But remember, a lot of times markets have pre-priced in movement into what's going to happen. And I think that it's the old story, buy the rumor, sell the news, or sell the rumor, buy the news. And of course, here, I would think it might be an opportunity. Now, again, it's a riskier trade because what we're really banking on is that they have already kind of priced in good earnings. I mean, the stock has actually come up from 144 to 160, so you've moved over 12%. Okay, and the expected move for the rest of this week is another 10%. So again, but that would be that's the only side I'd be playing if I were going to play a sider. Coin. Again, kind of stuck between a range now, 120 to 140. Again, it got well overbought, then it got oversold. Now we're just churning, and here we are, right back at the mean. I would think that probably based on the chart action and the price action, you'd want to look at if it got back to 140, you might want to look to sell some premium. Again, I'm still on the selling premium trip here, and not because that's what I prefer to do, but it's because that's really what the markets are giving you right now. Okay. Again, you can only take what the markets are giving. Okay. And you're not getting enough extension in any real market right now. I mean, there's a few out there. Again, don't get me wrong, but the extensions are few and far between. And I hate giving up that much action when I can sit there and put myself in a better position. Okay, and I think that, again, trying to sell some premium is more the better position. Meta continues to go higher. It is amazing. And, you have an expectation of movement of about 10% for the rest of this week. So another $40 plus or minus. Look, again, it's way overbought. Are the earnings already priced in? I mean, look at where we've come from. And just in the last 3 weeks, the stock is up almost 20%. Okay. Is there more? Listen, there's no limit to how high they can go. And the only limit to how low they can go is to zero. So again, would I want to be a buyer or a seller in a market that's already rallied 20%? And again, I'm not talking about long-term. I'm not talking about being negative. I'm talking about just looking and playing the chart action. Okay. You got a stock that's well overbought going into earnings that's already kind of exploded. Is it one that I want to continue, that I can think can still explode? My answer is probably no. Okay. Google, which has earnings today, pretty flat. Again, my opinion is there's more likely a pullback off of earnings than a continuation of the rally. Again, another stock that has rallied almost 10% from the recent bottom. To me, I have to assume, based on information, based on what everybody knows, markets have a tendency of pricing in information before it ever hits the street. Okay. So the clues that Google has given those in the know probably suggest that their earnings are going to be good. But now the real question comes, if the earnings are good and the earnings are what expect that they've already expected, remember, it looks like they're expecting good earnings. So if the earnings are what they expected now, then the stock really only has one way to go, which is lower, because we've already seen the market overbought into this condition. You can see it by, of course, the Bollinger Bands. IWM, really in consolidation. Looks like it wants to break to the upside, getting to a point where it's a little bit overbought and probably a candidate for sell some put spreads. Microsoft has earnings this week. Again, another one that has had almost a 20% move from the recent bottoms. And again, doesn't mean it can't go up 30%. Again, I don't ever want you to think that they cannot go farther. But the real thing you want to remember is that, again, what is the probability, of the next, basically, if you're playing any of the stocks we talked about so far, other than IWM, is you're talking about what's going to happen in the next 3 days. Okay. You've got the earnings, you've got the Fed tomorrow. So where are these going to be on Friday? Because that's the premium that you're going to sell. Okay. So to me, again, I'm not a big fan of getting involved in earnings, but typically if I'm involved in an earnings trade, I've already got it on and I've got a neutral trade on that will benefit from big movement either way. Or if I'm going to play it late, like I would be doing this, I'd be playing this against which way it was moving, if it was moving in any significance. And of course, 20% is pretty significant. So I'd be more looking for a pullback if I were going to trade it. But I'm certainly telling you straight up that your risk is more higher and unknown, because again, the earnings could be much better than they're expecting, which could explode it through. And even though it might come back down, it might not come down soon enough to get you out of a jam. Okay. Now that's why we put these trades on, because the risk is so much limited. And basically, if you put on a $2.50 spread for, let's say, $1.50, you're risking $1 to make $1.50. That's really what you're trying to look for. Okay. NVIDIA continues to go. It is amazing. And of course, you know that I've told you I've lost some money on this stock trying to sell it. And not because I'm negative in NVIDIA, but because it's been overbought and I've been looking for opportunities. And here it has not worked. But remember that if I'm not doing it again right now, but if I were to do it again right now and sell, let's say the 632.50 or whatever, 635, it doesn't have to go down. It just got to stop going up. And unfortunately, since I got involved after this blow off down here, it hasn't gone down. Okay. And it hasn't stopped going up. So that's one of the things you have to remember. Again, it ain't easy and you're not stealing anything. You're using the probability, and you have to be willing, if you're going to use probability, you have to be willing to let the market to be wrong and to take some losses along the way. There is no guarantee that there's 100% winners. The Qs, again, kind of sideways here. Now, because of the reports that are coming out this week, Google, Amazon, Apple, Microsoft, whatever other tech stuff is coming out, Facebook, Meta, whatever they'll call it. Again, those are things that will have a direct effect on the Qs. Okay. So right now with the Qs going more consolidation wise and really relieving this overbought condition, maybe I don't sell this so aggressively. Okay. Because again, here, if I go to the individual issues that are going to make up the move here, I have a higher probability, because one or two of the issues could be a loser if I'm in one or two, but it could still drive this index higher. So if I go here, I'm banking everything on that they fit versus not. Now, of course, the one difference and the one big benefit of the Qs is they're daily. So you could sell the spreads for today. Okay. And of course, you could be out before the Google earnings even come out. So that's something to take a look at if you'd like to. I mean, to me, if it popped up to 428, I'd probably look to sell some spreads for the day, and again, if I can collect, $30 or $35 a contract, okay, do 5 contracts, I'm risking $320 or $325 to make $175. Okay. But again, the odds are that I'll be able to collect that if I make that trade. Square has reached the upper level here and is now at resistance. Again, they have earnings next week, so you've got some time. Certainly, this is one that has come from the bottom. Now we're up at the top. I would certainly look to sell, and the premium is pretty juicy in in the Square. SPYs, very oversold. I apologize. Very overbought. Here I'm selling. I've already sold myself. I sold the 491, 492 for 38 cents. Okay. Again, I'm going to take that chance. I have no worries about that. And I'm gonna, again, if I'm wrong, it'll be a loser. That's the point. I'm not going to worry of whether or not it's wrong or not. I think that I'm right. I think the probabilities are right. I think everything fits into my position. So that's why I'm going to make the trade. Tesla, I did sell some put spreads down here. Okay, earlier, last week and early this week. So again, I think you'll see a little bit of a bounce. I think if it gets to 200, now then you have a choice. Now sometimes we get to 200, which would be resistance. If you've sold call spreads already, you could turn it into an iron condor because you're going to have probably as much credit as your risk. Okay. Because now you've had a big move. If you did sell the put spreads down at the bottom, and now if you sell call spreads, you're going to be able to spread up all the risk and have a chance to collect all the money. And those are things, those are trades that you look at when they move in your favor, depending on the kind of credit that you can collect, okay, as to how you put yourself in the best position. When you guys weren't with me last night on the Monday call, but I said that this was overbought and would probably see a little bit of a pullback. Well, there it is. It's this morning. Now, there was nothing you can do. It was, I talked about it after the close, but here you go. Okay. And here it is right back at the mean. And again, so what you should probably find some support around 94 and look for a potential for it to continue higher. And again, and that's really what you're watching in the market. Again, you got to remember we have news this week. You've got already news you've got today, but you've got earnings today, tomorrow, and Thursday. Okay. Big numbers that are coming out. You've got the Fed tomorrow. Okay. So that's why the markets are actually so quiet right now. Okay. Because you have a lot of news that can drive the market. Okay. Now, if you see later today, they start to anticipate, and a lot of times that will happen, right? Either somebody thinks they know, either the Duke brothers think they know something, or there's some anticipation of news on either side. You could see the market start to move early. That is the danger of trying to trade into some of these numbers, because you can get into a tougher position as they start to take off, especially if it's late in the day. Like if you do the Qs and all day it's a perfect trade, it's a perfect trade, and then all of a sudden at 3:30 Eastern you're still in, and suddenly they start to make a little bit of movement. There's a little bit of knowledge, and the movement is against you. Well, you're kind of screwed. Okay. So again, it's nothing that you should be afraid of. Again, if you're prepared for the risk and you're prepared for the exposure, then that's all that you need to worry about. Okay. Again, if you know where your exit is or you know where your end is, then you don't worry about it. It's like when we're day trading in the futures market. I don't ever worry about it because I know what my risk and what my exposure is. Okay. If I make it now, I have no trades to make right now. And if I did, I'd make them right in front of you. I don't care. But again, there's nothing for me to do right here. So why should I, what am I going to get involved in? But when I do put a trade on, I know exactly what risk I'm taking and the amount of risk that I'm taking. And if you learn to recognize the risk and the comfortability for yourself, okay, and each person will be different, but the risk has to be pretty standard, okay? You have to give every trade you make enough room to allow you to make money without getting stopped out accidentally. Too many people try to put stops in too tight. They get stopped out and then the market moves their way. And I think that's a big problem because, listen, this is a business, okay? And nobody's giving away $100 bills on the street corner. If you are not prepared for the risk, Okay, you have to give it enough room to give yourself enough room so that in case it goes against you a little bit right away, that you don't get banged out right away. Because more often than not, it'll run against you for a moment. And if you're too tight, you're out, it goes your way, and you sit there and say, what happened? Okay. So I think when you're looking at it, and typically one of the things you can use is the average true range, if you know how to use that. And if not, we'll go through it on Thursday. But you can look at using average true range as a stopping point, and that the average true range is on each individual time frame that you can use, or you can use a standard deviation move. Again, you can use the Bollinger Bands as a stopping point. For example, if I'm using, the bands here, so let's say I'm going to go to a short-term trade, and let's say we'll use a 15-minute chart. Okay, let's use the Qs because that's the one we're looking at. So here I know that on a 15-minute basis, the two standard deviations up is 428.5. So it's about a $2 move either way. Okay. So if I sell, let's say the 427, 428 spread, okay, then I'm not using a stop. The stop's already built in. But let's say I decide to buy a put here. Okay. Well, then I know that if the stock moves $2, that's where I'm getting out. Okay. Against me. Or if I buy a call, if stock goes down $2, that's where I'm getting out. So there's different ways to define your exit point. But however you define it, it should be based on some mathematical theory, okay? Whether it be using the Bollinger Bands, whether it be using the ATR, the average true range, okay, of that period. Again, because each time frame, right now we know that the total move from top to bottom in the Qs is about $4. Okay, so 2 and 2. If I change this to a daily model, okay. Now my average true range is $40. Okay. So again, it changes based on your time frame. Your risk changes based on your time frame. I should have shared that with you. So there you go. Okay. Your risk and everything is based on the time frame that you're trading. The shorter the time frame, the lighter the risk. Okay. Now the nice thing about using shorter time frames, okay, like these, is you can still catch a big runner, okay, and then turn it into a longer term trade after you've locked in some profits, okay. But of course, obviously the risk of getting stopped out, because of course, on a 4-minute scale on anything, if I take this down to 4 minutes, which is those charts are, my standard deviations are only like $1 apart. So again, it's all into the math. First of all, it's deciphering the chart and what the direction is and where you are. Okay. Then it's determining the type of trade you're going to use. And if you're going to use an open-ended trade like buy a call or buy a put, then you have to determine the amount of risk that is tied to that call or put. Okay. And I hope that makes sense. I know I said a lot, but obviously I'll continue to teach this each and every time we get together. But remember, there's nothing for free out there. Everything that it takes a method and a system and an idea. Okay. And by using the charts and by using the equations and the different areas in which you can decide of what type of trade you want to make, you have something that can help you use to confirm where your exit point should be on the risk side. On the profit side, you want to manage your risk on the way up. For example, I get stopped out of almost every trade, but just because I got stopped out doesn't mean it was a loss. The stop, I'm like right now, I am short the 10-year notes, okay, from about 12 ticks higher, 12 points higher, but I'm going to let them run, but I've got room. So when I do get stopped out, if I get stopped out, I'll get stopped out at a profit. And that's what the business is about. It is about profits. That's what we're trying to do. In the meantime, I'll see you back here on Thursday. Have a great day, everybody. Thanks so much. And we'll see you back here with Trading with Bubba on Thursday.